On June 12, 2026, SpaceX listed on the Nasdaq under the ticker SPCX at an IPO price of $135 per share, implying a valuation of approximately $1.77 trillion, the largest IPO in history. At 9:30 that morning, the U.S. stock market opened as usual. But this most watched new listing sat completely still. An indicative quote didn't appear until around 10:15 a.m. The first actual trade came a little later, opening near $150 and closing at $160.95, about 19% above the IPO price. Many Chinese investors watching their screens were baffled. The stock listed today. The market is open. So why can't I buy it? Why does the underwriter get to decide when trading starts? And if the exchange is already open, why not just let buyers and sellers match each other directly? Why does a big investment bank get to hold things up for over an hour? The confusion is completely understandable. It reflects the experience of anyone familiar with China's A-share market. On the Shanghai and Shenzhen exchanges, a newly listed stock trades from the very first moment of the session. A call auction runs from 9:15 to 9:25 a.m., continuous trading starts at 9:30 a.m., and anyone who wants to buy or sell submits an order through their broker directly into the exchange's matching system. No one in the middle decides when to flip the switch. Compared to that, Nasdaq's approach, waiting for the underwriter to judge that price discovery is complete before releasing the stock for trading, looks both slow and oddly authoritarian. But if you keep pulling on that thread, you find that this small time gap isn't a technical detail. It's a fork in the road between two entirely different market structures. To understand it, we need to answer a more fundamental question first. Where does the very first price of a stock that has never traded before actually come from? A price that has to be discovered. Any stock that's already been trading has yesterday's closing price as an anchor. The market has a continuous shared sense of what it's worth, so opening at 9:30 a.m. is smooth and unremarkable. A newly listed stock has no such anchor. The $135 IPO price was set by the underwriter the night before, based on the order book built during the roadshow. It reflects the appetite of institutions and retail investors who participated in the allocation process. It is not the same as what the open market is willing to pay. As it turned out, the moment trading began, public market supply and demand pushed the price to $150. So how do you produce a stable first trade, one that won't immediately crash or spike out of control, when there's no price history to work from? Nasdaq uses a mechanism called the IPO cross. Before the open, there's a window where orders can be submitted, modified, and cancelled, but nothing actually executes. The exchange broadcasts a real-time indicative price, the number of shares that could be paired, and the current order imbalance, but no trades happen. Meanwhile, the lead underwriter, Goldman Sachs in this case, acts as a stabilizing agent, watching the order book as it evolves, and only pressing the release button when it judges that prices have converged, that buy and sell sides are roughly balanced, and that opening trading won't trigger disorderly volatility. At that moment, a call auction executes the opening trade, and continuous trading begins. SPCX not trading until around 10:30 a.m. wasn't the underwriter being difficult or arbitrary. For the largest IPO in history, massively oversubscribed, this price discovery process genuinely needed time to converge. The more orders there are and the more imbalanced the buy and sell sides, the longer it takes to find the clearing price that maximizes trade volume. In economic terms, the underwriter and the exchange jointly engineered a deliberately slow adjustment process, preventing the price from jumping to its equilibrium in a single leap so as to avoid overshooting. Hong Kong solves the same problem differently. The Hong Kong market has a separate public offering tranche for retail investors, plus an allocation clawback mechanism, which means popular IPOs end up with a large number of small retail accounts that are already holding shares before listing, all of them eager to sell or cut losses the moment trading starts. That demand is large enough that brokers stepped in to offer a gray market service. The night before listing, brokers like Phillips Securities or Bright Smart internalize and match these orders within their own systems, releasing some of the first-day buying and selling pressure in advance. The Stock Exchange of Hong Kong still runs its own pre-opening auction the next morning to establish the official opening price. The gray market is just an unofficial pre-market layer stacked on top. The contrast is now visible. The U.S. concentrates price discovery in an official, underwriter-led opening mechanism. Hong Kong adds a broker-internalized pre-market layer on top of the official auction. Either way, price discovery requires a capable intermediary to shoulder the work. That is precisely the assumption being silently made and quietly skipped over in the Chinese investors' question of why not just trade directly on the exchange. The real question, is there an empowered middle layer? Just trade directly on the exchange sounds completely natural, but it actually presupposes a specific market structure. In China's A-share market, newly listed stocks can trade from the opening bell precisely because the Chinese market is highly flat and fully transparent. Every investor's trading and settlement account, retail included, sits directly in the systems of the exchanges, clearing houses, and custodians. Brokers in the middle are essentially pipes. Unlike their international counterparts, they cannot hold client stocks, client cash, or client margin on their own books, and they cannot internalize and match orders between clients. Retail orders bypass any intermediary and flow directly into the exchange's central matching engine. In other words, the reason A-shares don't require the underwriter to release trading is not that the mechanism is more advanced, it's that there is no empowered middle layer capable of doing price discovery in the first place. The job falls entirely to the exchange's call auction, which handles it instantly and mechanically, processing every order in one flat sweep. Charles Lee, former CEO of Hong Kong Exchanges and Clearing, described this structure in an article after the 2015 stock market crash as flat and see-through. He noted that roughly 90% of A-share turnover comes from retail investors. In mature markets, the composition is nearly inverted. Institutions account for 60 to 70% of trading in Hong Kong and have consistently exceeded 70% in the US for years. International markets are fundamentally a three-way dynamic between listed companies, intermediaries, and institutional investors. Retail participation is limited. The A-share market is the most direct and universal market for ordinary people anywhere in the world. The question, why not just trade directly on the exchange, can therefore be reframed as a structural judgment. Does this market have an intermediary layer that has both the capability and the authority to handle price discovery and liquidity provision? Where the answer is yes, markets evolve mechanisms like the IPO cross, gray markets, and market maker internalization. Where the answer is no, orders have no choice but to collide directly with the exchange. The difference between the three markets ultimately comes down to how thick that middle layer is. Hong Kong's broker layer is thick enough to internalize, so gray markets can exist. The US middle layer is thicker still, and further differentiated into specialized wholesale market makers, which is why the underwriter-led opening mechanism exists, and also why the practice of selling retail order flow to market makers, payment for order flow, or PFOF, exists. Mainland China's middle layer was effectively removed, making gray markets and PFOF structurally impossible. Why did China's middle layer end up so thin? That requires going back to the origins of the system. How the structure got this way in mature markets. The intermediary layer grew organically, from the bottom up, over more than a century. Investors started as wealthy individuals, and the demand they created gave rise to brokers. Early brokers functioned like small private exchanges, buying and selling on behalf of their clients. Brokers then joined together to form exchanges. From the 1970s onward, the middle class and long-horizon institutions, pension funds, insurance companies, poured into mature markets and became the primary clients of the broker community. This layered structure is the product of natural market evolution, with regulation stepping in as a referee only after the structure had already taken shape. The Shanghai and Shenzhen exchanges are barely 30 years old. The securities regulator, the exchanges, the brokers, and the retail investors were all born at almost the same moment and grew up together. In the early phase, the era commonly described as wild growth, problems were inevitable. Brokers misappropriated client margin accounts to speculate on stocks. Market manipulators cornered prices. This prompted regulators to take decisive action, launching a multi-year broker cleanup and rectification program starting in 2004. In Charles Lee's framing, the result of that cleanup was that the market's middle layer was effectively removed. The A-share market became the unitary, flat, fully transparent structure it is today. So the A-share structure is simple not because that's its natural form, but because it is the sediment of a deliberate regulatory choice. The middle layer didn't fail to grow, it grew crooked, and was pruned back. When we say China's market is the simplest, looking at it from the perspective of market topology, it really is the result of subtraction, fewest layers, no dark pools, no payment for order flow. But looking at it from the perspective of the rulebook, it's the result of addition, the densest web of rules and protections around retail investors anywhere. These two things are not unrelated, they are two sides of the same path choice. Precisely because the middle layer was removed and retail investors were left to face the market directly, regulators had no choice but to step in themselves, constructing an elaborate set of upfront rules to shield inexperienced retail investors from risk. There is no free lunch, neither structure is purer or better than the other, each has its costs. The flat, transparent structure has real advantages because cash, securities, and custody are all centralized in a single system. Brokers have almost no opportunity to steal or misappropriate client assets. Retail investors are safest at the account level. For regulators, every account's trading activity is immediately visible, maximum transparency, and with over 200 million retail accounts participating directly in price formation, ordinary people have more direct involvement in markets than anywhere else in the world. But the downsides are equally significant. The market participant base is highly homogeneous retail investors, with few institutions holding different views to provide a counterbalancing force. This makes herding behavior and one-directional chasing and panic far more likely. In turbulent conditions, the risk of a stampede increases sharply. There's a subtler paradox that Charles Lee identified. Precisely because the exchange is highly transparent, regulatory attention is concentrated there. The 2015 crisis, ignited by margin lending through off-exchange channels, largely invisible to regulators, burned for a long time before anyone noticed. Safety at the account level does not equal stability at the system level. The thick middle layer structure has precisely the opposite set of trade-offs. Professional underwriters and market makers handle price discovery and liquidity provision. Openings are smoother. Diverse institutional views provide a buffer against one-sided momentum in volatile periods, but the cost is opacity for regulators. MF Global misappropriating client funds. Lehman Brothers quietly accumulating toxic assets across layers of intermediaries that no one could see until it was too late. Both are products of that opacity. Intermediary layers extract rent and create conflicts of interest. Payment for order flow has been widely criticized for potentially compromising best execution. The UK banned it in 2012. The EU decided to ban it entirely starting in late June 2026. The US still tolerates it. The comparison makes the point. So-called structural superiority is mostly a different combination of binding constraints, transparency versus professional buffering, direct democracy versus herding risk. Account level safety versus system level stability. Behind every advantage is a cost. Once you choose a path, the constraints lock in. The more important question for Chinese readers isn't which structure is better. It's that once you walk down a particular path, the institutional constraints lock in, and what works in one system usually can't simply be transplanted. By choosing the flat, transparent structure, China made it very difficult to graft in American-style mechanisms. Without a broker middle layer capable of internalizing order flow, gray markets have nowhere to live. Without empowered market makers, payment for order flow and underwriter-led opening mechanisms lose their structural foundation. Even if you admire the professionally discovered opening price on Nasdaq, you can't simply copy it, because that mechanism presupposes a middle layer that was deliberately removed years ago. The deeper constraint is self-reinforcing. Because retail investors dominate price formation, regulators must continuously protect them, which produces the lottery-based IPO allocation system, daily price limits, special trading rules on listing day, and an entire scaffolding of upfront protections. And because retail investors are so heavily protected upfront, they never develop independent risk judgment, which makes them more dependent on protection, which requires more protection. This is the closed loop that Charles Lee described as the paternalistic mentality. Protection breeds dependence, and dependence demands more protection. The reforms of the past decade have essentially been an attempt to break this loop, to rebuild the thickness of the middle layer and shift pricing power toward institutions. The full rollout of the registration-based IPO system in 2023 returned the gatekeeping function for new listings from administrative approval to market mechanisms, and the A-share market has begun to take on more institutional, longer horizon characteristics. The institutional share of holdings has been rising. By 2025, Domestic and foreign institutions together held close to 40% of tradable market cap, while direct retail holdings had been compressed to around 30%, but path dependence is hard to escape. Most fund money still originates with retail investors, and the pressure of subscription and redemption cycles, combined with performance ranking incentives, pushes fund managers to behave much like retail investors anyway, a phenomenon sometimes called the retailization of institutional money. By the third quarter of 2025, measured by freely floating market cap, individual investors had again crossed back above 50% of holdings, and the retail character of the market was reasserting itself. Retail investors may hold under a third of total market cap, but they account for 60 to 70% of turnover, with a velocity of trading several times higher than institutions. The constraints set in motion by removing the middle layer 3 decades ago remain clearly visible today. These constraints run in both directions, and China is not alone in facing them. The US cannot achieve Chinese-style account-level security and transparent penetration without dismantling its middle layer. China cannot grow an American-style professional price formation mechanism without rebuilding the middle layer it removed. Every path is internally coherent. Every path carries constraints it cannot shake off. The question, why can't you just trade directly on the exchange, is really asking, does this market trust a professional intermediary layer to discover prices on its behalf, or does it flatten everything and let everyone participate directly? Both answers are valid, both carry costs. The mature attitude isn't to envy another market's cleaner price discovery while clinging to your own safer account structure. It's to clearly see which constraints your own path has locked in, and within those constraints, look for the space to improve. There is no free lunch, especially not in market structure. Trading starting at 10:30 a.m. and trading from the opening bell are both the surface expressions of two different logics, each complete in its own way, each incomplete in its own way. Understanding that matters far more than arguing